welcome everyone, and a special welcome to our panelists here, and especially Ian flying all the way from Toronto, and David flying all the way from Montreal. Thank you guys so much for being here. And is Max on? We also have another panelist dialing in from Canada. Okay, great. Again, welcome everyone. My name is Tina Wei. I am the co-founder of Princeton View Capital Advisors. We are a Hong Kong-based investment advisory and asset management firm. We advise and also manage our clients' global alternative investment needs. I began my career as a fund manager and asset allocator based in the United States, and I relocated to Hong Kong for my US firm to cover the Asia investment. We mainly focused on global alternative investment, including venture capital, private equities, and real assets. And without further ado, I'd like my panelists to introduce themselves.
I'm Jim Hildebrand. I walked over from Pacific Place. I'm from St. Catharines originally. I went to Western a couple years in math, did math, and then law school in Toronto. Practiced briefly in Calgary, and then went on to Stanford, joined Bain & Company in London. I was with Bain Company for 20 years in London and Sydney, and I moved up here in 1993. I joined Bain Capital in 2005. Bain Capital and Bain Company are separate firms. And I've been building out the Bain Capital team across the region over the last 20 years.
Good afternoon, everyone. Ian Carew with Northleaf Capital. I'm based in our Toronto headquarters, but we do operate globally through 10 offices globally. We manage about $27 billion across venture capital and private equity, which is half the business, and then the balance is split between a direct infrastructure and a direct private credit business. And I manage the venture capital and growth strategy.
Good afternoon, David Després. I'm Executive Vice President at Letco Brosso. The firm was established in '87 as a fundamental investment firm, and today we are one of the leading independent money manager in Canada. And we invest broadly across public markets in Canadian equities, international equities, emerging market equities, and also public infrastructure.
Great, thank you. And I have to say that through my prior experience and as a fund manager, as allocator, I got connected with many of your today's panelists here, like Jim. You know, Bain is a global, well-known investment platform, and we were, my prior firm, we were long-term believers and supporters of Bain's investment model. And of course, Ian, you know, I got to know you through my early years as well. Yeah, so thanks so much for coming again.
Don't forget Max.
Yes, oh, Max. Sorry.
Yeah, well, thanks for everyone's patience.
This
online. Thank you.
This is what happens when you're not here, when you're not travel. You should fly here.
Yes. Well, thank you, Ian. It's good to see you, and thank you, everyone. My name is Max. I'm the co-founder and president of For Growth, and we are an alternative asset manager focused mainly on North American multifamily rental housing, and also in the energy sector in Canada. Thank you.
Thanks, Max. Next question is going to be for you, okay?
Oh, okay.
So just to set the stage, let me provide a really brief comment on the state of the market in terms of global capital market. So 2024 has been a very strong year for the global equity market, especially U.S. Equity market, but both marked by both optimism and also cautious when we move into 2025. On the very positive note, it was a banner year for the U.S. equity market with growth stocks and also the large cap outperforming. And as we know, the 2023 U.S. stock market finished 2023 with 23% gain. And on the private side, private equities and venture capital investment also demonstrated pretty resilient activities in terms of fundraising and deal pace, investment to different deal flows. And congratulations to Jim for Bain's successful oversubscribed Fund 5. Bain Asia closed $7 billion AUM for your fifth strategy in Asia. And I understand Northleaf also successfully closed your venture growth strategy as well. And I'm sure the Max, you guys successfully rolled out your private REITs product as well as the oil and gas, investment as well. David, you're on the liquidity side, so there's not so much fundraising or investment for you. The widely accepted drivers of the investor optimism for 2025 are deregulations, as we know, whether it's the cryptos and blockchain market or the private equity players started lobbying the government about, penetrating into the either pension or savings, retirement savings plans. And on the other side, thank you. And also especially advancement in the crypto and blockchain market. And of course, the second thing is the innovative technology and AI. That's going to really drive the investment thesis and also the investors' optimism in 2025. But on the cautious front, we understand the intensified geopolitical impacts and deglobalizations, and of course, uncertainties in the interest rate environment again, especially given the most recent sort of healthy non-pharma data released by the government. So people are started thinking or suggesting maybe there's going to be a delayed or reduced rate cuts. So we're not sure about interest rate environment again. So these are all contributing to the investors' uncertainties. And of course, liquidities, especially for the private strategies, venture and growth equity and buyout to the extent, has been dynamic or challenging to extent. And what will be the outlook for us, from our panelists for 2025? With that, I'd like to start with our first question. That is by asking our audience about, our panelists about your 2025 investment insights over the overall ecosystem. I'll start with Jim.
Sure, thank you. We're involved in private equity, regional buyout fund, large buyout funds, mid-market, and also venture and crypto, as well as real estate, special sits, and credit. So in that context, I think the question is more around also North America. How attractive is North America or individual markets? And I do think North America it's by far the biggest of the alternatives markets. The biggest players are in that market. It's the most diverse in terms of the funds available, the types of asset class you can invest in. It's been growing very strongly, not quite as, maybe somewhat less than, say, India or China, but still growing very strongly. There are extraordinary technology and healthcare opportunities that are not available elsewhere. So a lot of Asian investors are looking at North America for those reasons. I guess the one challenging spot would be real estate, just because of all the changes through in COVID, work from home, technology changes. We do opportunistic real estate focused on sectors that still have very strong growth and not so exposed to those trends. So there still are opportunities in real estate. That's probably the one area you need to be a little bit more careful. Otherwise, North America looks very attractive. I would say on interest rates, we're probably in a period of what are kind of average interest rates if you look at a longer period of time. I'm not sure if they're going to go further down or further up, but our industry has operated with these kinds of interest rates for a long time.
Yep. Ian, maybe you can comment from more from a venture growth equity ecosystem.
Sure. So in North America, I would say it was a bit of a mixed year, 2024. In terms of fundraising by venture capital funds, it was probably down 20% over 2023 and probably 50% down from the market peak in 2021. On the investment side, it was actually an up year, 30% more capital invested into technology companies or venture-backed companies in 2024. A lot of that has been driven by AI. Particularly the LLMs, which took a very significant portion. I think just OpenAI raised $7 billion alone. A number of the other large platforms raised multi-billion-dollar rounds, so that does distort the numbers. And then we'll talk about, I guess, exits or liquidity later. But I think that's where venture is kind of treading water today. Way we need sort of M&A to pick up IPO exits and drive that exit liquidity for investors, where again track records are kind of just ticking along, waiting for that next catalyst to provide that liquidity and upside returns for investors.
Yeah, my understanding is it has been a pretty positive market in terms of investor sentiment on private market strategies in the past few years.
Yeah, I would say Q4 was a very strong quarter. So if that continues, then 25 should be a much more robust year than 2024.
And David, would you mind share with us about your insights, especially towards the global equity, North America, mainly U.S. equity market in 2025?
Well, first of all, we are quite cautiously optimistic about the economy. I mean, we think that the economy are functioning well. Inflation is coming down. We think that rates will continue to come down. We have nice income growth. So on the economy side, we of the camp that we will be avoiding recession and that the economy will grow nicely in 2025. Now turning to the equity market, I mean, we're just capping 2 years of 20+ performance, by the S&P 500, and we believe that this is very unlikely to be repeated. We're quite negative about the prospect for index investors, in the U.S. in particular, for a few reasons. First, if you look at the S&P 500, I mean, it's trading at pretty much record valuation, about 50% premium versus its long-term average. The profit margins are very elevated. But also, if you look at last year, 60% of the gains came from only 7 stocks. And as a result of that, I mean, this is a very narrow market. And in fact, I mean, the gains, one has to go back to 1930 to find a period under which the gains were concentrated into a handful of stocks. So for us, I mean, this speaks of concerns. And the last point too is that we find that the U.S. dollar to be very overvalued, and this against pretty much all currencies.
Can you talk about your, you mentioned you have an emerging market strategy as well. Can you talk about overall, a portfolio construction when you think about, North America versus emerging market?
So at Letco Brasso, we are bottom-up investors. So we are definitely not index investors. So the idea is to invest in our best 50 to 60 ideas globally. And when we look at the world, I mean, there's about 10,000 publicly traded companies. So we believe that it's possible to sidestep the risks that I've just described by investing in a small selected portfolio of carefully chosen securities. And currently, our portfolios, we have a nice exposure to emerging markets, about 20%, maybe a third in the US, 20% Canada, and the rest would be international equities.
Thank you, David. And Max?
Yes, thank you. Tina, I think you mentioned a lot of uncertainties. The way our firm operates is we're a much niche player. We want to look at things that we believe has a higher degree of certainties going to 2025 and really capitalize on that. For example, we have some big political changes coming in 2025, both in Canada and US. One of the themes you mentioned is deregulation, and we also see both sides of the borders big emphasis on returning to traditional energy investment, both in the Canada side and on the US side. So we do believe that this could be a good opportunity, especially given 2 reasons. The AI theme you also mentioned is driving up incredible demand for energy, and also given the current geopolitical risk around the world, we see a lot more demand from the Western world on more political friendly energy sources. So we do believe this is going to usher in a period of time, make it very attractive to return to traditional energy. And the second theme is I do believe that because of inflation and elevated mortgage rates, housing starts and housing supply has been very stagnant. So this also provides a lot of opportunity, given the bigger theme of housing prices, to continue to buy affordable housing at a fraction of their replacement cost. So that's another theme that we think will present a lot of opportunity. I do agree with other panelists. We do see in the later half of 2024 that fundraising and appetite into alternatives has really picked up. So we are very excited to deploy that in 2025.
Great. Thank you, Max. So maybe we move on to our next topic with highlight on the Canadian equity market and the capital market. Well, let's just say we start 2025 with leadership uncertainties and a tariff threat from the elect President Trump. But all of you have and also had a Canadian market investment mandate and exposures and track record. So we would like to hear your insights about Canadian investment. I'm going to start with Ian this time. As I understand, the Northleaf has a very focused strategy, relatively speaking, compared to the other, mag cap private equity guys. You guys have a focus on mid-market buyout and infrastructure investment, private credit, and also, of course, venture and growth equity. So you're one of the longstanding and very well-known, investors in the private space in Canada. So share with us about the overall Canadian, investment landscape, the sectors, and also, of course, the opportunities and the challenge that through your lens of making investment in Canada. Maybe a couple of case studies if you can.
Yeah, so maybe I'll focus more on the venture and growth market. That's where I spend most of my time, on the venture and growth space. The Canadian market has really developed extremely well. I started in this business in 2000 or 99, but if you compare the Canadian venture and growth ecosystem in 2000, 2008, 20 up to today, it's been a dramatic improvement in development of the ecosystem. I'd say typically, very Canadian-like. We under-promote kind of what's going on in Canada, but again, the industry has developed extremely well. One anecdote is about half of the capital that's invested in the Canadian venture ecosystem is coming from primarily U.S. venture capital firms. So they've recognized the opportunity set in Canada. The companies tend to be a little bit cheaper. It's a little less competitive. And is taking advantage of the great university systems, great technology. That's always been a core part of what's gone on in Canada. I'd say some of the challenges that we're facing. And maybe one of the big opportunity. AI is obviously a big opportunity everywhere. I think Canada's got a very good case to be made as a leading destination for AI investment. There's 3 advanced labs, global leaders. Jeff Hinton won the Nobel Prize this year. He's one of the godfathers of AI. So that is one specific sector where there's a lot of strength in Canada. Looking at some of the challenges, the biggest one that faces us, and David, you mentioned this, is the currency impact. So I guess both is currency, where the Canadian dollar doesn't go as far as it did even just a few months ago, and then this potential impact of tariffs. If that goes, what implications does that have? Again, most of our companies are export oriented. None of the venture companies are really being developed to focus on the Canadian market.
Great, thank you. And Jim, my understanding, I know this for a fact, actually, Bain has a very long history and record investing in Canadian consumer and consumer services industries and retail companies such as Shoppers Drug Mart and Bombardier Recreational Product and BTI System and the Canadian Goose. So, also my recollection is Bain is really well known to employing your integrated global resources to help portfolio companies to grow and scale globally. So can you share with us about what do you see the opportunities from a mid-market buyout or even buyout perspective in Canada today?
Yeah, we've had a lot of success with Canadian companies. I think it's probably our most successful country. Our investments have all done extraordinarily well there. I just give the examples of Bombardier Recreational Products is, ski-doos and sea-doos. I'm sure some of you have these at your lake houses or ski houses. And they are, we've owned this company for a long time, or a part of the company for a long time. It's a listed company, so I can't talk too much about it, but it is one that when COVID hit, people thought, well, that's not going to do well for this sort of company. But quite quickly, and so the stock went down, but quite quickly people realized that most of the time on a skidoo or jet ski, you're on your own. So quite quickly, it became a very good thing to have, and we pretty much sold out the whole pipeline of product that we had. So that turned out to work out okay. Canada Goose we owned, and I remember when there's so many growth opportunities for Canada Goose at the time. Just a regional example, there were people from Korea that would go to Canada and buy a container load retail of the product and then go take it back to Korea and sell it. That's how much demand there was for it, and how poorly we were doing at distribution at the time. So that was a great opportunity. So we've just had a lot of success stories. Dollarama was a huge success, actually. So Canada is a great place to invest, particularly if you can find companies that have those sorts of growth potential. You can take them international, and it's been just a great experience for us.
So 2025 beyond, I mean, for Canadian investment.
Yeah, I think in relative terms, Canadian assets are lower cost rate, and the multiples are lower. You're buying in Canadian dollars, which is probably artificially somewhat low at this time. So I think Canada is a really good opportunity. When you think of North America, that includes the United States and Canada, and people sometimes forget the Canadian opportunity, and I think it's worth looking at that. And particularly from Hong Kong, we have something like 300,000 Canadians here. We have lots of connections to Canada. There are lots of interesting opportunities that are sometimes overlooked.
Great, thank you. I'm going to turn the mic to Max. Max, as I understand, your strategies has been pretty much focused on multifamily private REITs, as well as oil and gas, upstream oil and gas investment in Canada. Can you just comment on those two segments that you've been focusing on in terms of the opportunities, 2025 again beyond in the Canadian context?
Thank you. I do think a lot of the native media coverage in Canada does overlook a lot of, I think, positive things in 2025 Canada has to offer. I think the change in our federal politics will spell more clarity for Canadian markets. I do believe there will be a return to our core competency. By far, our biggest export is the energy sector. And by a lot of measures, our asset prices and our currency and even the operating costs in Canada are very cheap. That's why you see a big influx of, just like Ian said, there's a big influx of US dollars into Canadian energy sector, especially in 2024. You see a lot of increase in M&A. You get a much better bargain in Canadian assets. As of recently, Canadian heavy oil prices and light oil price spread is the closest it has been for many years. The price for Canadian heavy oil has been very, very strong. And so we do believe that will be a bargain and opportunity, especially with more political support and deregulation from the federal level for overseas investor to take a look at. And second of all, I do believe from a multifamily perspective, our investment in Canada has actually done very well. We had very successful exits and refinancings in 2024. And we believe that we're able to, in this current market, to buy a lot of very good strategic assets, probably at a third of their current build cost. So this will be really like a short window of period of time to really invest into workforce housing and a lot more affordable end of rental housing in Canada.
Great, thank you, Max. David, can you please elaborate on the Canadian, equity perspective? How big is your portfolio, Canadian equity?
So I would say that at Letco Brasso, Canada has been our best market. Like over the last 37 years, we have made almost 15% per year compounded by investing in Canadian equities. And of course, we believe that a lot of this is due to our investment approach, how we invest, our structure. But also, we think that the country has some very strong key characteristics that have been key enablers to this success. The first is that Canada is the second most competitive economy in the G7. It's also a country with very vast resources. We have great universities, which are supplying what we need in terms of a very skilled labor force. This is the biggest democracy by land mass. And as I said, we have plenty of natural resources that the world will need plenty in the future. So I think that if someone was given those characteristics, at least as an investor, those are attributes that we're certainly looking for when we make an investment. Now, looking at the future, we think that one of the key mistakes that people are making with Canada is that they tend to lump it together with the U.S. They just simply look at this is a natural extension to the U.S. market, and they simply avoid it. Well, we think this is a big mistake because if you look at the Canadian market, like the public market is trading at 12 times earnings, which is 50% cheaper than the U.S. market. And as a result of that, we think that there's plenty of value opportunities that are waiting for investors to participate.
Mm-hmm. I guess also from a wealth management perspective, when people think about overall, allocations to North America, there's always this big portion of the U.S. market. On the equity, public equity perspective, generally speaking, how much do you think people should allocate to Canada?
Well, if I look at typically I think one of the lazy approach in terms of investing in Canada is to simply look at the weight of Canada in the overall world, and the contribution of Canadian GDP to the world GDP is around 3%. So this is typically how people go about this. But we think this is wrong. And one is simply to look at the U.S. market. The U.S. market accounts for 20% of the world GDP, but 70% of the world stock market capitalization. We think that the approach that we take is that one is to look at this from a bottom-up basis, like stock picking, and invest in the best company. And in our case, Canada has nothing to envy to any other markets in the world.
It's a great point. I have a question here from someone. What can or should Canada do more for international investors to invest in Canada? This is a question for all four of you guys.
I think part of, like my comment before, I think part of it is just promoting the opportunity in Canada. I think we've done a poor job of that. Again, just for that. And we found that in our own fundraising, sort of there is this affinity between Hong Kong and Canada, Asia, or China specifically in Canada, and people are looking, again, they have some kind of a positive perspective on Canada, and that is driving some investment. I think we just need to tap into that more to drive further activity.
I would say that the Canadian sovereign wealth funds have been the most successful investing overseas and taking their business overseas and doing a great job producing returns and being even local in Asian markets, for example. So that's a big success. The counter to that, though, is that Canada has a huge proportion of Canadians overseas that are not really encouraged that actively to invest in Canada. So to me, that's a kind of missed opportunity.
I would add to also as a government we have to put a pro-growth agenda. This is what's been missing. I think we have a great potential. Now we can deliver this economic potential in a much better way. I find, and also we have to keep educate investors that Canada is not just a part of North America, but it's a large economy. And there's plenty of opportunities to invest. invest, and also talk about the value. Like as I said, I mean, it's trading at 50% of the value of the U.S. stock market, and the currency is providing a great entry point. I mean, when we run purchasing power parity models, like we find that the Canadian dollars should be trading at 87 cents. It's only trading at 70 cents. So one should think that down the road, I mean, if you make an investment today, I mean, you should benefit from a nice tailwind.
Yeah. And also, Maple 8, right? Canada has the largest pension investment program and one of the most successful investment program in the world. I mean, that's a very big topic, but maybe that's also an angle, like government can put, I don't know, a cap on their investment strategy and say, hey, this portion of investment we can go to domestic market. That's just my thoughts. And
Yeah, I
Max?
was going to add to that, Tina, quickly. Like, I think that is a very big conversation in Canada today around encouraging, as Jim said, the Maple 8 are, world recognized for being very sophisticated investors.
Yeah.
Probably other than the case, they don't invest, Case of Depot, they don't invest as much in the Canadian ecosystem. So I think there are a lot of conversations. There's been some press recently around encouraging them or finding a way to get them more active in the Canadian Canadian market.
Yeah, that's good news. Max, you have anything to add?
Yeah, I mean, there's a lot of foreign investment in Canada. Like Ian mentioned before, I mentioned a lot of that come from the U.S. I think Canada does have a lot of room to grow its presence and attract more investors outside of North America. Like I said, the currency is cheap. A lot of good assets are much better, offer much better value. And I think, especially given the political talk between U.S. and Canada right now, is very crucial for Canada to diversify its investment base and audience to a more global audience. I think that's why a forum like this is, very helpful.
Mm-hmm. Great, thank you. So let's move on to our third topic on liquidity mechanism. Most markets, as we know, are experiencing different or dynamic, if not challenging, when it comes to exit opportunities and the different way of creating liquidities for investors and LPs. Especially, of course, the private market strategies. So this time, let me start with Max. So Max, you focus exclusively on real asset investment that we mentioned earlier, including private multifamily REITs and oil and gas. Can you give us some more detailed description about how do you generate those liquidities in terms of you have a high yield return expectations for your oil and gas versus a stable long-term 10% returns out of your private REITs. How do you generate those returns?
Yeah, I mean those are two questions. I think it's true given the high interest rates, a lot of alternative assets has been dealing with the liquidity issue because I think it's really about the mechanism of a liquidity event. But for the assets that we choose, I think that we're very keenly aware of that. For example, in our multifamily sector, we don't really have to sell a building to create any liquidity for our investors. On top of the monthly rental distributions we give to our investors, we can also, because the debt servicing on the property, if given, is very strong, we can actually refinance out our equity. Given one example, we were, our property in Waterloo, student housing, we bought it for 2 years, and we were able to, even with a higher interest rate, refinance the equity out in 2024, simply because the rental income has been great, had seen great growth in the last 2-3 years. So, from not just a very stable distribution, we're also able to generate liquidity through different means other than just a sales transaction. I think that's very valuable to an investor in this day and age. On the energy side, we have been Similar theme. The cash flow has been very strong for a lot of oil and gas investments because it's a cash generating business. In 2024, oil and gas investment, we're able to pay probably around 40 to 50% dividends to our cash flow dividends to our investors. So, that's also, obviously very successful from an investor's perspective. So I think it's very important to make sure you have good cash yield and cash flow in the underlying asset, so you don't have to generate artificial liquidity. I think that's kind of our strategy. Yeah.
Great, thank you, Max. So Jim, for Bain, again, liquidity mechanism is so important for GPs and LPs. Can you talk about across different strategies, as you have mid-market, you have Asia, you have global. Can you talk about how exactly Bain has been execute on those activities, especially when it's creating liquidities for LPs? Because it's been, IPO market is very different, and there's M&A, there must be different ways.
Yeah, definitely. There's a lot of ways to exit. There are IPOs in individual markets. We've had IPOs over the last year in India, Japan, U.S., other markets. We sell to strategics. That's going on all the time. We sell to some of our competitors at times. And there are also ways to continue holding the asset. Maybe 1 out of every 20 companies we own, we want to hold them for longer than 5 or 8 years. And those can go into a continuation fund or other vehicles. I think when you think about liquidity, and we've had a very good liquidity over the last couple of years, but what are you using the liquidity for? I mean, the main thing you really want your investment partner to continue investing at a high return, and our general hold period for any individual asset is around 5 years or so. So you buy at the right time, you sell at the right time, but there seems to be a lot of demand by investors for semi-liquid funds. And by the way, you can sell the secondary also as another way to sell in private equity. But I think there's too much emphasis on liquidity from the investor perspective. There clearly are times when you need liquidity, but you should be managing your portfolio so that you don't need access to all of your funds all of the time. That's not going to produce the highest return. Every time you ask for more liquidity and access, you're probably reducing your return.
So it's more about, it's more important on the portfolio construction from that perspective, managing the liquidities.
Yeah, I think betting with a partner for a longer period of time allows them to buy the company, do whatever blueprinting and transformation that they want to do. We generally buy things, for X and try to sell at 3X or more over 5 years. That's our business. Mm-hmm. And if you look at all the volatility in the world going on right now, that's not a bad time period. You can kind of predict, or at least try to predict or plan around the next few years. It's harder, frankly, over 10 or 15 years to do that. But I think our business is aligned around a nice time period where you can sort of look at the macro and blueprint a company and try to take it through that growth phase.
Thank you. And Ian, maybe for Northleaf, especially for your expertise on the venture growth space, liquidities, obviously, it's quite important. Can you talk about that?
Yeah, I'd say it has been challenging since 2021. The amount of liquidity has obviously significantly decreased, which has created opportunities for, really, we've flipped it around and it's become an investment opportunity where we're doing a lot of secondary transactions where we're providing that liquidity to investors that really, there is no M&A, there is limited IPO. So it's just become a much more robust alternative to generate liquidity for investors. We use it both to manage our own portfolio. We'll look at an investment, and if we think it's the right time to sell, then we will find a secondary buyer, and then we're very active on the other side providing liquidity for, and I'd say in Canada specifically, that a lot of the companies tend to be smaller in size. So we see a lot of the U.S. private, like almost every of my growth companies has a bunch of U.S. private equity firms or larger growth equity firms that are looking to use it as a platform or as an add-on to one of their existing platforms. So we see that as a kind of a third alternative that's really emerged over the last number of years to generate liquidity for investors.
Yeah. Great, thank you. I think we have 4 minutes left. It's just on the very quick note, on the footnote of the liquidity, which is a good segue into the asset allocation, which I think it may be benefit for a lot of audience here in the wealth management perspective. As we know, the asset allocation, diversification, portfolio construction has been built into the institutional investors program from long time ago, from day one, but not until recent years, especially in the last few years in the high interest rate environment. A lot of wealth capital pools here in Hong Kong, maybe globally, and high net worth investors has learned the lessons from that experience. So they started really thinking about how to build into institutional investment program in terms of allocation, diversifications into different strategies, and the different geographies. So do you guys see that reflected in your LP base, and then also on the top of that, as Ian, you mentioned about different strategies, right? Semi-liquid strategies, secondaries. Do you see that? Also see the trends from your LP base as well? Looking for that kind of diversification?
Yeah, I'd say that's, we are primarily an institutional backed across our strategies, but the fastest growing segment has been high net worth and family office over the last 5 years, so it is certainly expanding as investors look to have that. I think it's two sides. One is the institutional market is pretty tapped out, so every manager is looking to tap into retail or broader retail or high net worth family office to continue to expand their fundraising. And then I think it's a sophistication on the other side where they want a more well-diversified, more of a endowment or pension plan type portfolio than just a purely kind of bond and public equity portfolio. Yeah. And then as it relates to semi-liquid, there are some very attractive features there where the capital gets to put, like in our own case, our fund, the capital gets put to work in 4 quarters, so it's a much faster pace in terms of getting your money put to work. There is a liquidity feature, so if you do need liquidity, after a 3-year lockup, you can put your hand up and effectively start to get liquidity, and you can reinvest distributions, so the capital compounds. So there's a lot of attractive features in those type of structures, particularly focused. We are getting some institutional support, but a lot of it is high net worth family office because of some of those dynamics.
Yeah, that's great to hear. Maybe we should open to a question, Q&A.
Hi, hi guys. Thanks. Really good conversation and really insightful. So this morning I was hearing that there's a real move towards smart cities and green investment, and then this afternoon I'm hearing the attraction for Canada is resources and a move back into traditional energy. So from a position of sustainability and wealth, family offices and that kind of scale of context of wealth management, how would you advise investors who were investing for the legacy of their grandchildren?
Yeah, so that's a very good question. I think in the last decade, the investment world has learned a lot about, ESG obviously it's a very, very big theme. And I think the energy industry has evolved to it. And recently, our Conservative Party leader did quote in an interview, for example, Canada actually can do a lot for the for global emission. One of our economists, Stefan Marion, actually in our national bank, mentioned just by exporting Canadian natural gas to replace half the coal power generation in India in the next 20 years, we can completely offset the greenhouse emission in Canada. So actually, we have such a small footprint by exporting more emission-friendly type of fuel to the world, which the world will need. The AI boom is generating a lot of energy needs. The growing middle class in India, in China, in a lot of the emerging countries will require energy. And right now, renewable energy, after decades of advancement, can only fulfill about 17% of global needs. Coal, by far, is still the biggest energy source. So about 2 billion people in the world still burns wood and animal dung. So actually, Canada has a lot to offer to the world to have a cleaner fuel source. So that is one aspect of what Canada can do to help. That's just one one of the many ways. I do believe there's a very complex topic, and we really wish that the world can switch to 100% renewable energy at a snap of a finger. But unfortunately, it's a slow progress. So we have to make sure we consider different approaches that, at the end of the day, probably what Canada can do as a small nation is probably to provide better, more efficient fuels to the rest of the world.
And one thing we're doing specifically around that is we just backed an energy transition fund. So again, helping make traditional energy sources cleaner. This is a former manager that was a traditional oil and gas manager. They've now got all those relationships that they're leveraging to again, try and improve, reduce the emissions of the oil patch in Canada. So that is one specific strategy that we're supporting as part of our venture fund of funds.
Yeah, I would just suggest three things. One is most big firms or most GPs in sort of private equity will do an annual report on how they're doing across their whole portfolio on the environment, so you can review that. Secondly, that they will have assets. Like we've owned the biggest wind company in Japan. We own a biofuel company for jet fuel for Europe out of China and Southeast Asia. They're within existing portfolios, so you don't necessarily have to buy an environmentally specific fund. You can look at that. But in addition, you should look at the funds that are specifically targeting alternative energy and see how they perform, and you can pick the best of those.
Great, thank you. I think our time's up, correct? Okay.